Hello citizens of the world. Thank you for joining Equity Economics. Short intro to Bitcoin, one of our favorite subjects. To create and manage Bitcoins. Bitcoin is awarded every time a problem is resolved. Bitcoins are made consistent with a protocol that pays agents, called miners, who have processed note transactions during a block. These agents use their computing power to confirm, secure and record transactions during a virtual note register, called the blockchain. This ledger confirms the true entity of transactions in a block connected into a blockchain sequence. For every new block accepted, the verification securing recording activity, called mining, is reimbursed by newly created Bitcoins and by the prices of the transactions processed. As a currency or a commodity, Bitcoins are often exchanged for other currencies, commodities, goods, or services. The cryptocurrency rate of exchange is a specialized marketplace and fluctuates consistently with supply and demand law. It's possible to shop for Bitcoins online, on technical platforms, physical terminals, or in exchange for any good or service with an individual who already has them. The transactions are often done from smartphone to smartphone. Exchange platforms also make it possible to follow the Bitcoin price evolution compared to other currencies or cryptocurrencies. Unit of account. The unit of account of Bitcoin is the Bitcoin. Its emission is restricted to 20,999,999.977 units, each divisible to the 8th decimal place, called Satoshi or Sat. The official currency Bitcoin symbol was deposited and accepted in 2015 with Unicode. The corresponding acronyms employed by the exchange platforms are BTC and XBT. Bitcoin blockchain. The blockchain may be a distributed, public ledger that contains the history of each Bitcoin transaction. Anyone can download a replica of the blockchain, and it is often inspected to trace the trail of Bitcoins from one Bitcoin transaction to a different one. It should be noted that while there's a record of each Bitcoin transaction ever made, these transactions aren't inherently linked to real-life identities. For this reason, Bitcoin is taken into account pseudonymous. Bitcoins themselves aren't files stored on your computer's disk drive like MP3s or PDFs. Instead, owning Bitcoins means owning a Bitcoin address, which features a balance recorded on the blockchain. It means to have a Bitcoin address to regulate the associated private key and thus allow the signing of transactions. Block. A block refers to a group of Bitcoin transactions from a selected period. Blocks are stacked on top of every other, so that one block depends on the previous. In this manner, a sequence of blocks is made, and thus we come to the term blockchain. Finding and publishing new partnerships is what Bitcoin miners do to earn Bitcoins. Whenever a replacement block is broadcast, approximately every 10 minutes, the miner or mining farm who resolved that block receives Bitcoin as a payment for the work. Bitcoin miners retain the network secure, and this is often how they're rewarded. This technique ensures that each transaction is valid and keeps the Bitcoin network safe from fraud. If you have ever waited for a replacement Bitcoin transaction to be confirmed, you were expecting a replacement block to be published containing your transaction. When that happens, the Bitcoin network has considered your transaction valid. Coinbase currently requires 3 network confirmations before the transaction is taken into account finalized. However, this number will differ from other Bitcoin services exchange services. Bitcoin and cryptocurrencies. Bitcoin is perhaps the foremost well-known cryptocurrency, but they are available in many forms, including Ethereum, Ripple, Litecoin, and Bitcoin Cash. These are all kinds of digital or virtual currency collectively referred to as cryptocurrencies. However, the less volatile Bitcoin and other cryptocurrencies become in the future, the more retailers and businesses will be willing to receive it as a legitimate currency. Cryptocurrencies face increasing regulatory threats, and with continually fluctuating prices, they are available with a high level of risk for investors. Bitcoin is simply one kind of cryptocurrency, a digital asset or money exchanged similarly to explicit currency. There is no physical commodity or fiat currency attached to a cryptocurrency, so there are no coins or notes, only a digital record of the transaction. This digital record is usually mentioned as a blockchain. A blockchain may be a historical document of every transaction verified by each computer within the network. The verification is completed after every transaction, for instance, when a cryptocurrency was sold and which account was credited and debited. Each cryptocurrency has its blockchain. Cryptocurrencies are so far only a digital representation, useful where institutionalized banking systems are not available, but on the same note may not be issued or guaranteed by a financial institution or public authority. This suggests that it doesn't hold an equivalent status of money, yet. They're generally not backed by any tangible asset and are currently unregulated, meaning if something goes wrong, you will not get any compensation. So, if you are looking to shop for or invest in Bitcoin or other sorts of cryptocurrency, you will have limited legal protection and excessive risk of losing much or all of your funds. Most investors in the field are aware of the high risk, still they recommend it to others in expectation of a high reward. It's often mentioned to invest more than you can lose. How are cryptocurrencies made? Bitcoins and cryptocurrencies are constructed through a process called mining. Anyone can mine for many cryptocurrencies, but it's a time-consuming and challenging process. Mining involves teams of computers resolving mathematical problems. When the matter is solved, tokens for whichever cryptocurrency was being worked on are created, for instance, a Bitcoin, and therefore the computer that got the answer gets the new pass. Mining is additionally what gives cryptocurrencies their security. The mathematical problems that are being resolved are connected to the blockchain, the record of every single token during a cryptocurrency. The newest mathematical problem doesn't just create more tickets, it also checks the unique transactions simultaneously. How to use Bitcoins and cryptocurrencies. Bitcoins and other cryptocurrencies are often exchanged for goods and services the same way as British pounds, pound, American dollars, dollar, the euro, and other currencies my own. To store and utilize your cryptocurrency, you'll usually need a specialized wallet with its unique digital address, allowing you to send and hold cryptocurrencies. Additionally to wallets, you'll also trade your currency on exchanges. A number of these exchanges also enable you to convert your everyday currency pound, dollar, euro then on, into cryptocurrency and convert your holdings from one sort of cryptocurrency to a different one. Why do people buy Bitcoins and cryptocurrencies? There are multiple legitimate reasons to use cryptocurrency in situ of everyday currencies like British pounds, euros or dollars. It's secure, cheap, and fast. It offers genuine technical innovations that the experts' belief will replace more traditional sorts of exchanges. Although, allegedly due to the transaction's anonymity, they may be employed by criminals seeking to avoid detection for unlawful activities. That reasoning may be also used for fiat currencies. However, people are increasingly buying cryptocurrencies for investment, hoping to make tons of cash quickly. The instability of cryptocurrencies means it's possible to obtain huge gains with small investments. But it is also possible to create huge losses during a relatively short space of your time. The risks of Bitcoin and cryptocurrencies. Investing in cryptocurrencies are often very risky. To buy and store a cryptocurrency is technically demanding, but most wallets provide the user with straightforward information. Anyhow, things can go wrong. I recently changed my phone and I couldn't log in, which according to the exchange it needed a day or so to get acclimated to my new phone. It was frustrating to say the least. All good, the virtual money was still there afterwards. The shortage of regulation and central authority means seeking compensation or making complaints is additionally very difficult. The cryptocurrency marketplace may be a target for fraud, so extra caution is required. Also, many exchanges are subject to cyber attacks during which individuals who have left their holdings on these exchanges have lost them. The volatile nature of the currencies means if you're investing with the hope of creating money, it's effortless but unstable. There is an associated risk that one may lose some or all of original investments. This is the question I ask myself often: do you prefer to be fooled in or a fool out? This video means to be educational, it's not meant to serve as advice in the purchase of Bitcoin or any cryptocurrency as a financial instrument or investment. Thank you for watching, please like or dislike, always share and try to subscribe for more content.